So let's move right into talking about some strategies, dealing with uncertain funding. What can you really do about it? And so this is starting at the higher level. This is the million-foot level, long-term types of discussions, and it's kind of hard to talk about the long-term strategies of improving your financial position and financial security when you're in the middle of a financial crisis. And if you can't meet tomorrow's payroll, what you're going to do 10 years out isn't maybe the most important, most urgent thing. And I get that, but certainly if you don't deal with these strategies, you're never going to get to a better place. And so, I'd like to at least spend a bit of time and talk about what can we do over time to try and improve our lives from a financial perspective. These strategies aren't going to turn your organization around this week or this month or even this year, but over the long haul, hopefully will get you to a place where you can avoid those, kind of organization-threatening activities or, changes in funding that really undermine your very existence and let you have at least a minimal level of security. So the first item that we want to talk about is diversification. And in my mind, this is really the number one priority that organizations need to deal with over time. And it is simply a matter of trying to ensure that you receive funding from several different unrelated sources. And we're going to talk in a bit of detail about what those sources are and how you might manage a mix of funding. But the objective here is to ensure that the termination of funding from any one source is not a threat to the very existence of your organization. So funding from one source is pulled, that certainly threatens programs and specific activities, and that's difficult to deal with, it's unpleasant to deal with, but it's a whole different game than dealing with the very existence of your organization. So, those are difficult but manageable decisions to make if you still have your organization as a viable operation. So we want to talk about two kinds of diversification. So the first is across different, what I would call funding sectors, and that is having different kinds of funding, and then the second is within each of those sectors. So the first is looking at having funding from several of, and I guess there's 5 that I would categorize: individuals, businesses, foundations, governments, and events. Now, events are really generally a combination of those other sources. You might get sponsorships from businesses, you might get individual fees or donations, but events are different kinds of creatures, so I really treat them as a separate type of source. So the question is, how many is right? How many of those sectors should you be getting funding from? And that depends on the organization. Every organization is unique. But I think one thing is clear: if you're only getting funding from one source, from one sector, that's a high-risk proposition. Because however certain that funding is, it's not absolute, because there are no absolutes in life. And if it goes, you're in a serious place. So on the other hand, having funding from all 5 of those different sources may or may not be right for your organization. Certainly it maximizes the amount of diversification if you're getting significant funding from all 5, but it also maximizes the complexity and challenge of managing your fundraising activities, because each of those 5 sources is a different kind of creature, and it's a different kind of business to be running, events as opposed to grant writing. So it may not be 5, it may be 3, it may be 4, it may be 2, I don't know, but that's something that you want to evaluate within the context of your own organization. In doing so, you're going to look at the type of programming you're running, how urgent and pressing is it? Does it need absolutely to be in place every day of every week and every month, or is it a less urgent kind of thing? What are the nature of your existing resources, not just financial, but also staff and volunteer resourcing, and looking at the funding, diversity of funding within those individual sectors, and that's really the next topic that I'll talk about. So within each of those sectors, individual, business, foundation, government, events, one of the objectives should be to try and have some diversification within each of those funding sectors, so that you're getting funding from several different places. again, this is an ideal world within those sectors. So for example, if we talk about government funding, you can get funding from several different levels of government, federal, provincial, municipal. You can get funding from different departments, funding for different programs, that type of thing. If you're looking at corporate or business funding, you can get, whether it's grants or donations from several different kinds of businesses. It could be, large and small, local businesses, national, international businesses, and from different sectors within the economy. And what you're doing is spreading the risk of problems affecting those organizations and thereby affecting their donations to you. So if we take an extreme example, let's say you had funding from several businesses, but they all happen to be car manufacturers. You might think that that would be a bit of a problem from time to time. Although they seem to be flush with cash because they have a direct line into Ottawa, so maybe you can get a piece of that. So obviously it would be desirable to go beyond that very narrow niche and to say, well, let's get several different types of manufacturers and not be exposed to economic factors or external factors that impact car manufacturers. Of course, you're still then exposed to economic cycles that affect the manufacturing sector overall. So let's go beyond that and let's look at manufacturing, let's look at service industries, let's look at primary resource industries, and let's mix that up across local businesses and international and small and large and all of that kind of thing. So again, in an ideal world, you'd have the greatest diversity of contributors and supporters so that they're not going to be affected by they're not all going to be affected by a certain circumstance that in turn impacts your funding. Another example of diversification within the sector is if we take events. And it would be desirable for an organization to have several different kinds of events, attractive to different audiences, held at different times of the year. Certainly I know from Windfall's own perspective that we had an event that was in late January. And lo and behold, where were a lot of dollars going in late January, but to Haiti. So, that particular event did not meet all of its goals, although we fortunately did reasonably well. But we have other events and we have other sources of funding that one external factor that was totally beyond our control didn't impact all of our funding sources. And the final thing to say about events is that events will typically have a life cycle of their own. And it's very rare that any source of funding will last forever. Events have that kind of life cycle where they will decline over time. Businesses and governments can change their priorities and directions. That can happen very quickly. And nothing lasts forever, I guess, is the rule to follow there. So I think that one of the goals then with dealing with this life cycle issue is taking what I would call a portfolio management approach to your fundraising. So viewing the collective sources of your funding as a portfolio of activities, both across those sectors and within those sectors. And you should always be trying to manage that in the context of bringing in new funders, whether they're new events, whether they're new businesses or individuals, that can replace the inevitable drop-off. So, people move on, they eventually pass on. Businesses go out of business and governments have different priorities. So you always try to replace and anticipate the decline of those existing funding sources by having new ones in the pipeline. The bottom line to all of that, of course, is that you never get to stop. You never get to rest. You never get to say, we've done it, we're well funded, we can coast for 15 minutes. So just to go back to Windfall as an example, what we've done over the course of about 6 or 7 years, and this in particular, I give huge credit to my counterparts and my other board members who have been far more heavily involved than I in some of the fundraising activities. But we have gone from one major event, which raised about half of our budget, to 3 or 4 events annually, and at different times of the year with very different markets. We do a golf tournament that's targeted at a very high net worth person. We do a fun kind of event that's in the fashion industry and very different kind of audience and that type of thing. The main event that we have had, we've also reinvented quite regularly. In fact, on an annual basis, we're always putting a fair bit of energy into changing the theme, changing the look, changing the feel, bringing fresh groups of people into that event to try and at least extend its life cycle, if not keep it going forever. We have when I joined, the other major source of our funding was from foundations, and again, about half of our funding came from foundations. We've had very good fortune at keeping those relationships going, and we're going to talk about relationships in a minute. But we also work very hard to constantly find new foundations that match our mission and that are willing to support us. And finally, last but not least, I guess there's two final things. One is we've also added an individual giving program within the last year, trying to promote and support individual giving. And again, that meshes nicely with a lot of our events because the events build our contact, our mailing list, and you try and nurture those people to come on in different capacities. And last but not least, we're looking to obtain government funding for core funding, and that is a bit of an uphill battle, but we are indefatigable, so we will prevail on that. So obviously it sounds easier than it is, and just adding one new event to your calendar is a huge undertaking. Deciding to develop all the materials that support an individual giving program is huge. The amount of time and energy that go into lobbying and talking and communicating on trying to line up government funding is enormous. So you really have to be careful, and you really have to take that long-term kind of approach. So from Windfall's perspective, it's still very much a work in progress, and that's 6-7 years later. But we see at least that we've reduced our reliance on the one major event that was, I think, a huge exposure for us. It was a great event, don't get me wrong, but all you need is 1 year of that event failing to achieve its goals, and you're in a painful place. So with that, I'd like to move on to the second strategy, and that's building reserves. Yes, preferably in US dollars, although maybe not these days. Yeah. I'd like to suggest that, again, over time, it's very important to build and maintain adequate financial reserves or operating reserves. And that means simply having surplus money on hand and above and beyond what your day-to-day operations require as a bit of a rainy day fund. So the first question, of course, is how much is enough? And everyone goes immediately to that place and says, well, how much should we have? And that's sort of the how long is a piece of string kind of question. There's a wide range of right answers. There are a lot of considerations in what the right answer is. But I will step out and say, as a rough rule of thumb, I think many organizations find it prudent to have something on the order of 3 to 6 months of operating expenses. Now, what are operating expenses? Part of that is trying to determine what are those expenses that you can't control that continue on. So staff expenses, for example, you can't easily lay off people. You can do it, but there are costs associated with doing that. You can't easily get out of your lease for office rent. And in fact, doing so, can really impact your operations. So those are the kinds of expenses that you look at and say, those we really need to cover because we really need to keep the lights on. We really need to keep people coming into work to keep delivering on our mission. Certain other expenses may not be as critical. Obviously, everything you do is critical or you wouldn't be spending it, but you may be able to put off some expenditures for 6 months in a time of particular critical funding difficulty. So, that is less critical than the things that you need to keep paying literally every month. So those are some of the factors that you need to consider. The other factor, I think, is the urgency of the programs that you're operating. What happens if you stopped operating your program for a month? Well, if it's a food bank, that's a different answer than it would be if you were an arts organization. And not to say one's more important than the other, but one has a whole different sense of urgency to it in terms of meeting the need both legitimate needs that the organizations are working toward. So that's all very nice, but how do you get this operating reserve? And it's not much different really than for us as individuals, and that is, you know, the bottom line is you have to make more money than you spend and you save the rest. But the first consideration, and I think again it applies equally to us as individuals as well as organizations, is you're never going to get there if you don't budget for it. And so what I'd like to suggest is that if you're not satisfied with the current level of financial reserves you're holding, is you have to start budgeting for it. Now that doesn't sit too well with some people. Some people think, well, if I'm going to go to a funder and they want to look at my budget and I'm showing a surplus in the budget, they don't want to fund that. They don't want their money left on the table. They don't want to be funding my bank account. They want to be funding my programs. And, you know, there's certainly some truth to that. But the other side is the funder that gives you money wants to know that the lights are going to be on 3 months from now. They want to know that you're going to be in business to run the programs and deliver on the mission that they're funding. That's what they want you to do. So, and you know, foundations of any size will also have their own issues about being solvent and run effectively and efficiently. And I think there's a level of understanding and appreciation that it's simply prudent to have a level of financial reserves. And even if a funder doesn't see it that way, I personally think it sends the right message. It sends the right message to all of your stakeholders if you say, we are budgeting to improve our financial stability. To me, that sounds pretty good. Now, that's the accountant in me, I guess, that appreciates that. But if I were going to give you a significant grant or donation, I would like to know that you're viable. And that's really what this is coming down to. It's your viability. So what do you do? What do you start budgeting for? I don't know. Maybe it's $1,000 a year. Maybe it's $5,000, $10,000. It's not going to be huge. You're not going to get there in a year, to be sure. Now, the other thing that you should be doing is budgeting conservatively, because what we're talking about is budgeting carefully, budgeting honestly and accurately, but budgeting in a way that the odds are that you're not going to be over budget, or you're not going to be overspent. So if you have the discipline to say, we see a surplus coming up for the year, we're not going to run around and try and spend it all. We're going to make a conscious decision to set that aside and add to our operating reserves. You can go a long way to adding to your financial security. So a couple of other things you might do, and these get problematic. So I'm not kidding myself here. These are not easy to do. But certainly one thing you might do with the right funder is to look at whether some direct program funding, some small portion of direct program funding might be diverted into adding to your operating reserve. I know it's enough of a battle with most funding even to get something to contribute to our administration, or overheads as we horribly call them. Lots of funders just like to, feed the children or whatever the thing is. They don't want to fund administration costs, although the more enlightened ones understand that that's part of running your organization. And maybe the more enlightened ones would recognize, particularly if that funding is helping to grow your organization, that part of sound growth is having a sound operating reserve that supports that. So, I think it's worth putting in. Again, what's the worst that'll happen is that you've sent a message to your funder that you're actively thinking about and looking for ways to improve your financial security. And there may even be occasions where you can find special purpose funding. It may be in combination with other capacity building activities, that there are funders out there that would actually help to fund that. I think that's a stretch, but it's something to keep your eyes open for. So if you can add 1 to 3% of your annual operating expenses to a financial reserve every year, and if you can have an under budget scenario every once in a while that then drops into your reserve, over a few years you can actually get to a place where you've got a decent sized reserve, and it really changes the way that you operate and the way that you think about your operations. Just a final note, and I mean this can be the subject of a whole discussion on its own, but as you build reserves, obviously one of the things you need to do is to start thinking about investing those reserves. Again, first step as you start to build something up, just to have a savings account rather than having it in your checking account. Not that there's a lot of interest getting paid these days anyway, but that'll change in time. As the amount builds up over what you might need for 30 days or 60 days of operations, then you can get into putting it into guaranteed investment certificates and staggering the maturities of those so you increase your interest a little more off it. As I say, there's a whole separate discussion around investing those amounts, but to do something is better than to do nothing, and what little bit of interest you might earn, again, just goes back into the reserve and helps to keep you on track as your organization grows over time, if it is. So the next strategy I want to talk about is communicating with funders. And building a relationship with your funders, I think, is absolutely critical. Having a relationship of trust, having a relationship of openness and candor with your funders is, I think, key, and again, in Windfall's case, has been key to the kind of continued support that we've had from them in difficult times in particular, because they've felt and they've known that we've been giving them the straight goods and that they will get the straight goods from us, good, bad, or indifferent. So I think it's an important thing not just to share the good news, and we all like to share the good news, but to share the bad news when the times dictate that as well. Communications as well, I think, is a two-way street, and the other part of communicating with the funders is not just always broadcasting out, here's us, here's our message, here's what we want you to know about us, but it's what we should know about them, and understanding our funders and understanding what their objectives are, what their goals are, and what their reality is as well. It just helps to form that solid foundation of trust. Now, I assume before you even approach a funder, a prospective funder, that you've done some homework, you've looked at their website, you've talked to other grantees that have worked with them and that type of thing. But going beyond just that kind of basic level of investigation and actually having a discussion and a dialogue and listening and understanding, what are your funders really trying to accomplish? What challenges are they facing? What's their culture and what's their operating style? Lets you work with them in a way that is most valuable to them, obviously while still working to achieve your own objectives. The other thing is, I don't think that's a one-time thing. I don't think you have a big flurry of activity and discussion at the front end and then leave them, they're fine, I got their check and I don't need to talk to them for another year. But keeping those regular communications, they can be formal or they can be informal, but just having that discussion on an ongoing basis alerts you to subtle changes that may be going on in their organization. It may give you a clue as to something that's coming up, a challenge they're facing. In the worst case scenario, it may alert you to a cessation of the funding that you need to deal with sooner rather than later, but better to know than not to know. The other thing that I would suggest in terms of communications is to look at the type of information that you're communicating and to look at a mix of the anecdotal and the objective information. Everybody loves the story, and the story is, the time-honored means of communicating among people, and the story brings your activities to life. The story makes things real to the people that hear those stories. So the anecdotal information, I think, is powerful, and I think it's important. Now, a larger funder is going to have, more objective measurements and metrics. They're going to set out, quantifiable goals at the outset. They're going to come back quarterly and ask for updates relative to those measures. That's all good stuff, and in fact, I think some of that, whether they're asking for it or not, is valuable. But adding to that, adding the anecdote, adding the story, adding the realism of what you're doing, I think is powerful, and it engages the foundation or the funder with your organization, and that's important and powerful over time too. It's also, the anecdote is also the opportunity. Well, we've done our quarterly reporting, but we just have to share this information, and it's nothing more perhaps than picking up the phone and calling them and saying, you won't believe what happened today. We had one of our clients come into our office and tell us what a difference that we've made in their lives. Well, that's powerful. And I think it really does serve to keep the relationship honest and current. So the final thing is that when problems do arise, what do you do about it? Well, the natural tendency when something goes wrong, you're failing to meet an objective, you're running way over budget, something horrible's gone wrong, there's a temptation to say, well, let's not mention that right now, or let's downplay that a bit. Things, we're working hard to correct it, and maybe things will be better next month, and we don't need to mention it at all. Bad scene, because if that doesn't work, you're now going back to them a month later or 3 months later or whatever with not just bad news, but old bad news and maybe big bad news. And on top of all that, the relationship has been tainted by the lack of communication. And it's like, well, when were you going to tell us that? And why weren't we given an early warning? So nobody likes surprises, but nobody really likes old surprises. So I think there are a number of advantages to being current, dealing with problems on a balanced, honest basis. It builds that trust rather than undermines it. If they know that you're coming to them on a timely basis, that's a good thing. Provides an opportunity for the funder maybe to offer some advice or some support. If you've got a funder and your mission is aligned with theirs, your goals are aligned, they're probably working in the area too, and they have some understanding of what's going on. Maybe they can offer some advice and support. But even if not, it gives the funder early notice of the possibility that you're going to have, a bigger problem down the road, that you're going to be over budget, that you're not going to meet some goals, whatever that is. And it just opens the door then to further dialogue about changes that you might want to make in your programming. We're according to the project, we're doing this. It's not working out the way we thought it would. Maybe we need to change gears here. Maybe we need to try something different. Now, I find it hard to believe that a funder would not be receptive to that kind of approach. I find it hard to believe that any funder would sit there and say, we funded that, and even though it's not working, just keep doing it. I really want to see my money just thrown away on something that's not working. So it's all win, really. As unpleasant as it may be to deal with a particular bit of bad news on a timely basis, I think there's only upside to doing so, and I think there's only downside to not doing so. The last strategy, and I just want to touch on this fairly briefly, is building a relationship with your friendly banker. And the main thing I want to say is that everything we've just talked about in terms of funders really applies pretty similarly, pretty consistently to the relationship with your banker. They want you to succeed. They don't want you to go out of business. That doesn't help them any. And they understand, even though their goals are profit motivated, they understand that yours aren't. They understand that what you're trying to do is something different, but that for you to be successful is defined in terms of your goals, not theirs. So they get that much. I mean, even bankers get that much. Even accountants get that much. Well, maybe I'm pushing it a bit. So, I think, again, understanding where the bank is coming from, what are they after, is, again, a useful thing. How can you be a better customer to them? Because if you're a good customer, they're going to want to keep you as a customer. They're going to want the long-term, yes, profitable relationship. But again, they're willing to invest, I think, in many cases, to stand beside you where there's a reasonable basis for doing so. Now, they're going to protect their interests. They're going to look for ability to repay on a line of credit or something that, they're not nonprofits. Although hopefully even we would try to protect our interests. But again, having that closer relationship and dialogue and level of trust back and forth with the organization gives them the basis to make that kind of determination. Are you able to repay? Will you have the ability to get the funding you need? And all of those kinds of things. So, and I think it is certainly something that can be the difference between survival and not, if you've got the banker on your side and they're willing to step out a bit for you. They're not going to do so stupidly, but they're going to do so where they think it's reasonable, and the only way that they would know it's reasonable is if they've had that dialogue and honest, trustful discussion with you. So I think it's worth investing in as well. So I'd like to move on to tactics, and I'm going to try and go through some of these fairly quickly, because these ones tactics get a little more difficult to talk to a room full of people, because they get far more specific and situational. You know, how you apply a particular tactic in one case is going to be quite a bit different than in the next. So what we're talking about, some of the tactics that we're going to talk about, are really aimed at improving the information that you have at your disposal so that you can do better decision making. There aren't any, you know, real silver bullets here that are going to solve all your problems in the short run, but there are things you can do that will fairly quickly help you to better understand what the immediate and near to midterm future holds for you, and lets you make better decisions about what to do in respect of those future factors coming up. So the first one I want to talk about is scenario planning. Sounds impressive, sounds complicated, but it needn't be. It can be, but it needn't be. And this is really predicated on the fact that the future is not a complete void. Yes, we don't know what's going to happen. You know, the only thing certain about the future is that it's uncertain. But equally, it's not a complete black box. You know, we do have some ideas. We do have some understanding of our organizations and their operations. Hopefully of our funders, if we've been having that kind of discussion. So we do have some information about the future. We do know some things, and we can guess some other things. And so scenario planning is really just a matter of fairly methodically looking at those future factors and trying to fairly methodically decide what the future holds in respect of each of those factors. And then trying to put that all together in a way that makes some sense to say, you know, what is going to happen here? One of the goals is really to try and see what the future holds overall for the organization. And there are lots of futures that you could paint as pictures for the organization. Some are pretty rosy. You know, you could paint a very positive picture. Some are not so rosy at all and pretty grim, in fact. But, you know, some of those scenarios are quite likely, and others are not so likely. And having an understanding about the likelihood and the severity of those various futures gives you the tools then to make some reasonable decisions. Not easy decisions necessarily, but hopefully reasonable. So how do we tackle that? And one approach is to use the consultant's friend, and the consultant's friend is the number 3. And consultants always use the number 3 for pretty much anything. And you always come up with 3 options. You always come up with 3 approaches or 3 tools or what have you. So what I suggest is that you come up with 3 future scenarios. 3 future scenarios for your organization. And we can call the first kind of a best guess or most likely kind of scenario. It's what we think is most likely to happen. And then we can look at a positive scenario, a better case than that, and we can look at a negative scenario. Now those positives and negatives are not, you know, the rosy future winning the lottery. They're not the doomsday scenario, because frankly, those scenarios kind of take care of themselves. You know, if you've invested everything in the 649 draw and you win, well, that's great. You know, the problems will kind of take care of themselves. And if there's doomsday and if all of your funding dries up, well, there's nothing you can do about it anyway. So why, frankly, waste a lot of time talking about those remote and extreme kinds of cases? So the key here is some realism, and say, well, let's not worry about those wild, extreme cases in the future, but let's just look at, you know, what if a bunch of things go right, more than we expect, but it's still realistic that it could happen. And on the other end of the spectrum, what if a few things go wrong? Still, you know, realistically they could. And coming up with then what I would call kind of the end points of that reasonable, likely range of outcomes. So this approach gives you a quick glimpse into what the future may hold. And you've got then 3 scenarios, the good, the bad, and the most likely, that you can start to work towards. And if you start to think through what you'll do in each of those scenarios, you've then made a good start at really planning for any possible outcome anywhere in that range. Now, this isn't always easy. If you've done some of the strategic work and you have funding from many sources, you have a large, complex organization, it's not simple to do this kind of forecasting or looking into the future. So you need to get a little more complicated, you need to get a little more sophisticated in terms of looking at, let's say, all of your different sources of funding and doing some analysis on each one. What is the likelihood of this grant continuing? What is the likelihood of this event, increasing its attendance or decreasing? And just going through, again, line by line, item by item, and trying to come up with a best guess for each one. It may be a best guess that you then say, well, it's, our best case and worst case are plus or minus 20% or 30%. Or maybe you look at each one and figure out, your best and worst cases. Either way, you just need to make some decisions item by item and add it up and try and get the total picture. When you do that, and again, we've done a bit of this at Windfall, we've started developing our revenue projections with a little more sophistication. So we get funding from, I'm going to say, about 25 different foundations. Well, what are the odds that we're going to get the same amount of funding next year as this year? I don't know. What are the odds, though, that one particular foundation is going to continue to fund us? Oh, well, that I can talk about because, I've been dealing with them on a pretty regular basis and I understand what they're going through, and they've actually done pretty well, and they've said, oh, by the way, they said they're going to fund us next year. That's a pretty good indicator. So that one I'm going to count, as 100%. We're going to get that. In fact, they said maybe they could increase their funding to us. So my best case is that they might increase. And I'll just continue to work through. And we continue to work through and apply, well, we don't even apply percentages. We just try and come up with numbers. Best case, they might increase it to, $12,000. Worst case, it might be zero. And the most likely case is that they'll continue their $10,000 grant. And we do that on a spreadsheet. We do that through each of the 25, and we come up with a range. Now, doing that, when you get that total range, sometimes those best and worst endpoints can look pretty divergent. And then you say, well, 25 different funding sources, not every one of them is going to have a worst case scenario, we think. So maybe that worst case endpoint isn't as bad as we thought. Similarly, 25 foundations, not every single one is going to increase their funding to us, so we can, back that off somewhat. And we end up in, it's, a lot of, this kind of judgment and estimation, coming with a reasonable kind of range that we say, we think we're going to get $200,000 from foundations next year. But there's a worst case scenario that says it's only going to be 150. And there's a best case that says it could be 225. Now we can start to plan and say, well, worst case, we're going to have a $50,000 shortfall. What will we do if that starts to emerge? And then we can set out, well, we may need to cut back this program some. That'll save us $10,000. We may need to lay off this staff. That'll save us, $20,000. All of those things, unpleasant decisions, difficult decisions, but we can at least line them up in priority. And as the numbers start to firm up, we go through the year and say, I don't think it's going to be 200. It's only going to be 190. And, as you get further on, you see the future with a little more clarity. And you say, okay, we're going to have to cut back this program because we already knew that was our sort of number one step in dealing with it. So that's been a valuable tool. Part of what it does is it takes some of the emotion out of it, and some of the emotion around, are we going to have to lay off staff? What about her family? What about, is she going to lose her apartment? Well, that, is a nasty thing to have to talk about, but let's at least start with some good information. So the next one I want to talk about is matching up cash flow. And again, this is a subject that there are whole courses on. There are whole programs about how you manage your cash and how you manage your financial position. At one end of the extreme, we know as organizations that cash comes in, from our various funding sources. Cash goes out for all of those various expenses. And that's ultimately reflected on the organization's income statement. When you look at the financial statements and it says revenue, expense, and you can see whether the revenues cover the expenses or not. Over time, they kind of have to. But that's a pretty long-term kind of picture, and that's sort of the big picture. At the other end of the spectrum is there's this immediate need. I've got 8 invoices on my desk, and the due date is Thursday, Friday, Friday, Friday. How am I going to pay them? And I go, oh, I don't have enough in the bank. And that endpoint is the cash management end of things. And that is not abstract accounting or financial reporting. It's real, it's relentless, it's day by day. How am I going to pay these today? And then tomorrow, it's how am I going to pay these ones? And tomorrow and tomorrow. So there's that spectrum. And then somewhere in between, there's a little bit more of a long-term plan that says, okay, we got our operating reserve in place, so we're okay this week, maybe this month, but let's start to look 6 months out. And do we really know what our picture looks like 6 months out? And so looking there, you can start to look at the balance sheet of your operation, looking at or statement of financial position, it's sometimes called, shows you the assets and the liabilities that you have. It doesn't tell you a whole lot about when those liabilities come due, when the assets are going to be cash, if they're going to be cash, and just how you can really match them up. And so you can go through something of an exercise where you start to do some analysis on that balance sheet. You can start to look at the assets that you have as an organization. The first asset you have is cash, and you hope you have lots of that, or cash or investments. But then you have other things that may turn into cash. You have a grant receivable. It's been approved. We just didn't have the check at the reporting date, so we recorded it as a grant receivable. When that check comes in, you're going to put it in the bank, and you've got cash. That's great. That's a good kind of asset because it's going to turn into cash. There's another kind of asset. Let's say your organization has a delivery van, and you use this delivery van to go around and help to operate your program. Well, that delivery van isn't cash, and it's not going to turn into cash. It's just going to get used up in operations. It's going to get older, it's going to get worn out, and you're eventually going to have to replace it. So it doesn't really help you from a cash perspective. It helps you deliver your program, but it's a different kind of asset than that grant receivable that ultimately is going to help you pay your bills. And then when you look on the other side, you're going to have liabilities, and some of those liabilities are, just the accounts payable that you have to pay, the bills that are due on Friday. You may have a mortgage, let's say, if you owned a building. Well, that's something that needs to be paid over a long period of time, so that's a different kind of thing. And as you start to match up those various things, you can start to get a picture over several months of where the gaps are and where the issues are. That's complicated by at least a couple of things, the first of which is accounting, because again, the accounting rules, to be honest, will often distort the information on your financial statements when you're trying to look at your cash position and your cash management. The accounting rules are set for a particular purpose, and that's to report your income and expenses to external parties, to third parties out there. They're long-term kinds of things. They're for a year's financial results. They just aren't designed to give you the information you need. So there's a lot that you need to do to back away from the information that the accounting rules generate, unfortunately. And there are lots of other adjustments that you'll need to make too going forward, because some liability that you have today, like that mortgage, you're not going to pay from assets that you have today. You're going to pay it from assets or cash that you get in the future, from future funding. If we had the cash to pay the mortgage today, we wouldn't have the mortgage. So we know that there are going to be those kinds of adjustments too. So it can be a complex exercise, but again, the matter of going through the exercise will often give you some insights into the resources that your organization has. The final thing that I wanted to talk about is contractual terms. And we as organizations, we put a lot of time and energy and effort into fundraising and generating revenues and getting those assets and investing those assets and maximizing the value of them. Sometimes we don't put as much energy into managing and controlling our liabilities and our obligations to others. And this is an area that I think there can be some definite benefits to. Generally speaking, obviously, it's simply good management that as you operate a program, build out a program, you're going to try and match it to the funding you've got. So you're only going to do what you've got the funding to do. Duh. But looking at the uncertainty of that funding, then introduces another element of how do you manage that program. So, you know, I've got 12 months of funding to, I don't know, staff a position in a call center. And that's great. I'm going to go hire a person to then operate that program. But I can't really offer them a permanent full-time position because the funding ends after a year and I don't know if it's going to be renewed. So, you know, we put that person on a one-year contract, understanding all around that that's the reality of the funding that is driving that decision. Because not to do that is really not too fair to that employee, because you're giving them a level of assurance and a level of permanence that frankly just isn't there. You're also disadvantaging the organization by maybe setting yourself up for having to pay severance or something. The funding falls through, you need to terminate the employee. Now you've got severance kinds of issues to deal with. You know, it's not a pretty picture either way, but I think at least being honest about it up front, letting the person know is fair. So similarly, you may have supplier relationships that are dependent on ongoing funding. I don't know, maybe you lease software or lease a computer system or something, and you know, the funding that pays for that may or may not be continued. Make sure you've got an exit provision in your contract with that supplier that says this is contingent on funding being available. And if this particular source or some other source is not available, you know, we give you 30 days notice, we're out of the contract, you know, whatever you can negotiate, obviously. But again, to be fair to the other parties, as well as protecting your own interests, I think is prudent all around. So just as a reminder, again, those tactics in particular are things that are far better illustrated by getting down and getting into a numerical example and kind of working through it. And I have developed some fairly simple spreadsheet tools to try and illustrate them. They're available on my website, and the session notes from the CLIP website give a reference to my website so you can track it down.